Welcome back to Investing Talk podcast.
Today we're looking at Strive.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis.
Yeah, let's do it. So Strive operates in the SaaS workforce optimization space.
Right. And the sentiment right now is really balanced.
Yeah.
I'd say there's a heavy emphasis on needing clarity, specifically on execution.
And that scrutiny, it really starts with their Q4 2024 earnings report, doesn't it?
Oh, absolutely. That report was, it was a definition of a mixed signal. It's what created all this tension we're seeing.
So on the one hand, you had the headline revenue figure, looked great.
Looks fantastic. It was $187.2 million.
Which is a really strong 29.1% year-over-year growth.
It is. But, and this is the rub, that figure just slightly missed what analysts were expecting.
And in this kind of market, slightly missing is treated like a major problem.
It is, because the immediate question is growth slowing down? Or is something wrong with the execution?
But if you kind of set that slight miss aside for a second, the underlying financials look superb.
They're more than superb. I mean, they point to some serious operational leverage. We saw huge improvements in profitability in Q4.
Like the gross margin?
Exactly. Their gross margin expanded to 71.4%. And to put that in perspective, that's a 530 basis point improvement.
So 5.3 percentage points? That's a massive jump in a year.
That's a profound shift.
Yeah.
And it carries right on down the income statement. You know, operating margin climbed up to 18.3%.
And that's the fifth quarter in a row they've expanded that margin, right?
Fifth consecutive. So they're not just growing, they are getting way more efficient at turning that revenue into actual profit.
And that efficiency, that's really the foundation of the whole bull case, which it sort of rests on two main pillars.
Revenue quality and just sheer financial strength.
So let's start with revenue quality. They've made a really big strategic shift.
And it is paying off big time. They moved super aggressively away from, one-off license sales.
Or that sticky subscription revenue.
Exactly. SaaS subscriptions now make up a staggering 86% of their total revenue. Just a year ago, that number was 72%.
And that's what investors love to see, right? Predictable, recurring cash flow.
And that cash flow is just stacking up on the balance sheet. They're sitting on what is basically a war chest.
A net cash position of what, $267 million?
Yeah. It's $312 million in cash against only about $45 million in debt.
Which is, I mean, when you look at their peers in the SaaS world, that's almost nothing. A lot of those companies are loaded with leverage to fuel growth.
But Strive's debt-to-equity ratio is tiny. It's 0.07. They're pretty much operating debt-free.
Which just gives them incredible flexibility. They can make acquisitions, they can ride out a downturn.
Without worrying about servicing debt, and you really see that strength in their free cash flow, the FCF.
Right, the cash left over after all the bills are paid.
Yes, and their FCF generation is, frankly, elite. For the full fiscal year 2024, it hit $94.3 million.
Giving them a 25% FCF margin.
A robust 25%. For a company that's still growing at almost 30%, that puts them in the top echelon of the entire sector.
What's interesting to me, though, is what they did with that cash.
The share repurchases.
Yeah, they spent $37.2 million on buybacks in 2024. If you have all these growth opportunities, why not pour that money back into sales and marketing to, fix the execution issue?
That is the critical question. I think the buybacks signal management is confident in the long-term value.
But it also suggests they might be prioritizing capital efficiency over just growth at all costs.
It's a risk management choice, really. They're rewarding the current shareholders, maybe thinking that the product itself is strong enough to drive that next leg of growth.
Okay, here's where it gets really interesting.
The moat.
What gives Strive its staying power?
It really all comes down to their data network effect. That is their moat. This isn't just scheduling software.
They're selling predictive intelligence
that generic HR platforms just can't copy. Their AI is learning from this staggering amount of data, over 1.2 billion labor hours.
1.2 billion, and it's anonymized real-time data.
From across 14 different industries. So every single shift that's scheduled, every clock in, every bit of efficiency, it all feeds back into this massive data set.
Creating a feedback loop. The more customers they have, the smarter the AI gets.
Exactly. And because of that data, they hold a key patent on their core function, predictive labor shortage forecasting.
And they claim something like over 92% accuracy.
Yeah, especially in really complex places like retail chains or hospital systems.
The value of that kind of accuracy is immense. I mean, in a hospital, a labor shortage isn't an inconvenience, it's a patient safety risk.
It's a complete game changer for them. It moves Strive from being just a software vendor to an essential partner.
Then that power is clearly attracting some major validation. I mean, we just saw that announcement about McKesson Corporation.
That is a huge win, a massive win. The deal is to deploy Strive's AI scheduling in over 1,200 U.S. hospitals.
So this is not a pilot program.
No, this is a full enterprise rollout, and it's projected to bring in $48 million in new annual recurring revenue over 3 years.
For a company that just did $187 million in a quarter, that is a significant pipeline anchor.
It provides a lot of confidence in their future growth, and you see that confidence reflected internally too.
With insiders and big institutions.
Yep. The CEO herself bought 15,000 shares back in March.
That's a strong signal. Skin in the game.
Totally. And beyond her, institutional ownership is very high, around 79.3%. Yeah. We also saw some heavy buying from some of the biggest hedge funds.
Like who?
Well, sources confirmed that both Citadel Securities and Bridgewater Associates upped their positions.
Oh, wow.
Yeah, between them, they added over 1 million shares. When that kind of sophisticated money moves in, it suggests they see the execution risk as temporary.
And the stock's technicals have also started to look pretty bullish.
They have. The chart is showing two really key positive indicators. First, back on March 5th, the stock confirmed what's called a golden cross.
So that's the 50-day moving average crossing above the 200-day, a classic long-term momentum signal.
Right. And then, more recently, the stock broke out above a key resistance level at $52.30.
On heavy volume, too.
On very heavy volume. It completed a multi-month cup-and-handle pattern, which technical analysts just love to see.
Because it often means a long consolidation is over and a big move higher could be starting.
It implies the sellers are exhausted and buyers are finally taking control.
Okay, so we've got proprietary data, huge free cash flow, institutional confidence. It sounds amazing.
No.
But we have to pivot to the headwinds, the reasons the stock isn't already much, much higher.
And the biggest red flag, the one that ties it all together, is the management turnover. The CRO leaving in March. The timing was just awful.
Losing your head of sales right when you're facing pressure on renewals is not a good look.
Not at all. Management called it a leadership realignment, but coming right after that slight earnings miss, it's just hard for the market to swallow.
It makes you wonder, is the problem the product adoption, or is the whole sales strategy broken?
And we have to remember, the Q4 miss was directly linked to pressure on SaaS subscription renewals in their big enterprise accounts.
So sales cycles are getting longer, or churn is higher than they thought.
And that is exactly what everyone is going to be watching for on the next earnings call.
Yeah.
Sales cycle duration and renewal rates. Those are the only metrics that matter right now.
Which brings us to the catalysts, because the next few weeks are going to be definitive for Strive.
Completely. The first big one is the Q1 2025 earnings call. That's scheduled for May 7th.
And the consensus is for what? $198 million in revenue and 0.42 EPS.
That's the expectation. And if they hit or beat that, the stock will stabilize. But like we said, everyone is going to be digging into those operational metrics.
They need to show that enterprise renewal rates are getting better.
If they do, all this pressure goes away. If they don't, well, that gap between the great fundamentals and the poor execution just gets wider.
Then a couple weeks after that, there's an even bigger event.
Investor Day on May 21st.
This one is crucial for the long-term story.
Absolutely. They're expected to unveil Strive AI 4.0, which is supposed to be this new autonomous task allocation engine.
So this is management's chance to change the narrative, move it away from sales problems and back to innovation.
They need a very clear roadmap showing how this new AI translates into real ARR growth.
And beyond the company itself, there's a big macro catalyst kind of looming in the background.
Fed.
Yeah, a potential rate cut. The market's pricing in about a 79% chance of a cut in June.
And historically, when rates go down, high growth, cash flow positive companies like Strive do very, very well. Their valuations tend to expand.
Because all those future cash flows are suddenly worth more today, it makes that 25% FCF margin look even more attractive.
Exactly. And, we have to at least touch on the rumors.
With the huge disclaimer that these are totally unconfirmed and speculative.
Completely. But the most interesting chatter is about potential early-stage talks with Workday.
Wow. An integration with Workday would be seismic.
It would expose Strive's tech to a massive global customer base overnight. Again, no filings to support it, but it's out there.
And then there's the broader, sort of ever-present rumor about an acquisition.
Always. Any high-quality SaaS asset with a real moat gets those. The whispers suggest a potential premium of maybe 15 to 20%. But again, just speculation.
Okay, so let's do a final risk assessment. The big one seems to be concentration risk.
It is a real concern. In fiscal 24, 62% of their revenue came from just two sectors.
Healthcare and logistics.
Yep. And while those are great customers, they're also vulnerable to big external shifts, especially regulatory changes in healthcare.
So how are they mitigating that?
They are diversifying. You can see it in the numbers. Retail is now up to 28% of revenue, and manufacturing is at 8%.
So they're moving in the right direction, but it's going to take time to get that concentration below 50%.
It will. But when you put all these risks, the concentration, the execution, the turnover, into the context of the valuation.
There seems to be a margin of safety already priced in.
I think so. The stock trades below its peer group on key metrics. The forward PE is about 38 times versus the median of 45.
And even more, on an enterprise value to free cash flow basis, which is their real strength.
They trade at 13 times versus the peer median of 18.
So that discount suggests the market is already punishing them for these risks.
Exactly. If they can just execute in this upcoming quarter, that valuation gap should close pretty quickly.
So where does this leave you, the listener? Strive is this perfect case study of a company with impeccable fundamentals.
You have the massive cash flow, the unbeatable AI moat built on over 1 billion hours of data.
But its immediate future rests entirely on management proving they can execute.
That upcoming earnings report in May, it's not just about the numbers. It's a referendum on whether they can stabilize the sales machine. The question isn't whether the tech works anymore, it's whether the team can sell it.
And that is the tension you need to be watching. If you want more analysis like this, make sure you are subscribed to Investing Talk podcast.